Hello, Econ students. This is your set of notes for the Fed. And before we talk about the Fed, it's probably good just to quickly mention when we talk about the money supply in our country, bear in mind most of the money that we have in our economy is imaginary. It's not tangible. The chart here from a while ago, I'd say almost 20 years ago, not quite that long. Just kind of illustrates that fact though. When you look at currency, you can see currency comprises less than 10% of the total amount of money that's out there. So most money is just numbers that are tracked on a ledger. Nowadays it's done electronically or digitally. But important thing to keep in mind then, that usually money is just this imaginary figure. Now, when we look at our money supply in the United States, we have a system known as the Federal Reserve Banking System that oversees how we manage the money supply in the country. The way that this diagram shows how it's made up is at the top, there's a board of governors. Underneath the board of governors, the Federal Reserve banks, of which there are 12 in the country, are overseen by the board of governors. The presidents of the Federal Reserve Bank and the 7 board of the governors meet multiple times per year. And when they meet, they form a committee known as the Federal Open Market Committee, or the FOMC. They help determine and guide monetary policy or policy regarding money in the US. Now, underneath the Federal Reserve banks in our system are the member banks. And these are the ones that you and I would go to, like a Wells Fargo or a US Bank or Spire or other depository institutions like credit unions and things like that. So, and then we're at the bottom. So American people go to the member banks and depository institutions. And if the member banks or credit unions need to take out loans from another bank and they can't get another member bank to loan them money, they can go to the Federal Reserve Bank for a loan. This especially becomes important in times of recession, or if we have several periods of recession in a row, then we classify it as a depression. But anyway, the system was designed because the government recognized the need to create a safety net, because at the end of the 19th century, moving into the 20th century, there was a series of bank runs where banks were failing. People would storm into the banks and they demand to withdraw their life savings. And of course, at some point, banks run out of money. They don't have every single physical dollar that people have deposited there because banks turn around and loan money out to people. That's how banks stay in business, of course. And so there, at the turn of the 20th century, there wasn't a way to save people's savings if the bank ran out of money. And later on, after the Fed is created, there's another step that's taken by the government, that is to create an insurance company, privately funded industry insurance company by the banks that guarantees people's deposits in the country here. So if you do banking at one of the member banks, they just call the FDIC, up to 250,000 of your deposits are insured by the government, even if your bank goes under. So $250,000. That seems to be a pretty reasonable amount, a maximum amount to store in the bank. If you have more than that to store, you're probably investing it in other areas. So President Wilson signed the Federal Reserve Act in 1913, creating this system. Now, at the top, you have the Board of Governors, of which there are 7 governors. One is appointed chairperson of the board, so that's the chairman of the Fed. The appointments last for 14 years, and they are staggered, so it means every 2 years there's a new appointment. And yes, you can get reappointed to the position, but keep in mind, if you're in that position for 14 years, a new president would be in office and he or she may or may not appoint you, although if you've done a good job, there'd be no reason not to. So the Board of Governors do participate in the Federal Open Market Committee of the FOMC. They're located in DC. They direct the monetary policy. And when I say monetary policy, an easy way for you guys to remember it is look at the word monetary, take the tar out of it, and you've got money. It's so easy to keep track of that in your mind, because we'll talk about fiscal policy later on, not in this presentation, but later on in the course. And so keeping those two straight, monetary policy deals with money. The Federal Open Market Committee, then, composed of 12 members, is the 7 Board of Governors, and then the regional bank presidents from the different Federal Reserve regional banks. A permanent member is the New York Federal Reserve president. Reason being is that Wall Street's located there, kind of a hub of our economy, whereas the other presidents rotate annually, and it's just for voting rights. All 11 of the regional bank presidents can attend the open market committee meetings and give input there. They just don't all have equal voting rights, so that rotates. The scheme that you see here, the schematic, is just an old diagram of the room in which the FOMC meets, and not so much the names that are important to note, but just kind of note underneath some of the different cities that have Federal Reserve banks. You can see at the table you have Atlanta, and you have Cleveland, and Chicago, and St. Louis, and Boston there. So maybe one of those members isn't exactly a voting member, because New York, of course, is. So they meet at least 8 times a year. I think in 2008, 2009, the period of the Great Recession, I think they met as many as 16 times that year. The most common tool they use to monitor our money supply is what we call open market operations. Now, when I talk about the money supply, visualize a balloon, right? And not a fully inflated balloon, but like a balloon that's maybe half inflated. And let's consider that the money supply. That's both imaginary and currency. And there's times where you want to make sure the balloon doesn't deflate too much or lose too much money, because then you run the risk of having a recession or economic slowdown. On the same token, you don't want to overinflate your balloon or put too much money into the system, because if the balloon pops, then you got terrible trouble as well. So there's 3 tools that we'll introduce you to in this basic economics class. There are more tools that the Fed has used to help kind of work with the money supply in hard times, but these basic 3 are a good intro level understanding. So tool number 1 is that they can buy and sell savings bonds, the U.S. saving bonds that perhaps you've had purchased for you or gifted to you. So if the government decides to buy savings bonds, they're going to be increasing the money supply, and they might do this in order to prevent a recession. So when they buy bonds, they're pulling the coupons that people have purchased in the past, and they're paying them off. By paying them off, that means they're putting money into the system. And if they're buying bonds, sometimes that means that they might be allowing a person who has a bond to cash in early. Typically, when you buy a savings bond, it means the government can borrow and use it for an X amount of years, like say 20 years. And then they guarantee a rate of return for you, like say 6%. Now, on the opposite side, if the government feels like there's too much money in the system or things are heating up too much in the economy, they can go and sell bonds and try to pull money out of the system. So think of the balloon as getting to be too full, and they want to get some of that money out of the balloon. Well, then what they'll do is give these certificates, these savings bonds. They'll offer them to folks, and with good rates, and that pulls some of that extra money out of the balloon so it doesn't pop. Okay, so that's one way, and the most common way that the Fed controls the money supply. Tool number 2 that they have, and tool number 3 actually also involve banks directly, member banks. So one tool that they have is they can look at the member banks or other depository institutions and change what's known as the reserve requirement. The reserve requirement is simply a number or a percentage of the deposits that people make at the banks. The banks cannot turn around and loan out 100% of deposits that are made. So say the reserve requirement is 10%. What that means is if I make a $100 deposit at a bank, the bank can only turn and loan out 90% of that deposit. They have to keep the other 10%. Now, if they lower the reserve requirement, that frees up more money that banks can turn around and loan out when I make that $100 deposit. See, if they drop the reserve requirement to 5%, when I make that $100 deposit, they can turn around and loan out $95. So that causes the money supply to rise when there's more loans made available. On the other hand, if they want to slow things down, they can raise the reserve requirement and force banks to hang on to more of the deposits that are made. So that's tool number 2. Tool number 3 is they can change the discount rate. The discount rate is the interest rate that the Federal Reserve regional banks charge member banks for loans that are made there, usually the lowest interest rate that you'll find. So in fact, in 2008, 2009, and for several years after, the discount rate for member banks to take loans from the Fed was 0%. So if they needed to borrow $10 million to cover their liabilities, they would only have to pay back $10 million. Sounds like a pretty good deal. That's one way that they could help kind of bail out banks out of a tough situation. Now, if they lower discount rates, what that does is it encourages banks to take loans from them. So the money supply will likely increase. Now, if they raise the discount rate, that's going to slow down spending or discourage banks from taking out loans. And when the interest rates from uh, the for the discount rate are raised, usually loan interest rates for loans from the member banks follow. And so then, if member banks are giving out more expensive loans, that discourages the American people from taking out as many loans. So that causes the money supply to fall or slow down. Now, there are 12 regional banks, and this map here shows how they're divided up. You can see they all have different regions where the Federal Reserve regional banks are located. Minneapolis has one of them. One of the cool things that I point out to students when we're in class, if you pull out a dollar bill and you look to the left of Washington's head, there should be a black circle. Within that black circle is a big letter. That letter corresponds with the number it is in the alphabet, and it can tell you where that dollar bill was introduced into circulation. So, for example, if I had a dollar and the black circle next to Washington's head has a big A in it, that's the first letter of the alphabet, that means that that dollar bill entered into circulation in Boston. So it was released by the Federal Reserve Bank of Boston. Now, if you have one from Minneapolis, I think it's I, right, is the ninth letter. So that's where it was introduced. So if you were to look at bills that you currently have, you get an idea of all the different places that your bill may have traveled to, or think about that, where it was introduced to, how it ended up in your pocket or your wallet or your purse or whatever you keep your dollars. It's kind of interesting to think about. You might ask, why do we have 12 branches? We'll get to that in a second. Just also want to make note that the regional Federal Reserve banks do not print money. They'll order money and receive it and distribute it and enter it into circulation, but they do not print it on site. There's only two places in the country that print bills. It's the Bureau of Engraving and Printing in Washington, D.C. and Fort Worth, Texas. The regional banks order the amounts they need to fulfill local demand, and they also get rid of old currency that's no longer fit. Why do we have regional banks? Well, we have a really large country, and so different parts of our country can be going in different economic directions at the same time. The example I give you in the bullet point is the activity on Wall Street and the agricultural market in Chicago could be moving in completely different directions at the same time. Another example I give to students is timely because right now it's October, and this is the height of economic activity in the upper Midwest. It's harvest season. So there's a greater amount of economic exchange going on. Down in the southeastern United States, the greatest period of their economic exchange is occurring in the winter months when tourism steps up. So what's happening here in September, October, November is different than what's happening in the southeastern United States. Just to give you an idea of the type of activity that a regional bank experiences, this is right off of the Minneapolis Federal Reserve Bank's webpage. They process about $83 million worth of currency every day. They distribute $44 million in new currency. They receive about $39 million back, and they destroy about $3 million of that. And typically, they're either shredding it and getting rid of it that way. The last piece of this presentation just deals with a few of the former chairmen of the Fed, just to give you a little historical background on the Fed. So this guy here, several different faces of him. He was the chairman of the Fed in 1987 through 2006. The significance of why I chose those dates, why I chose this one, is that he presided over America's longest period of economic expansion from 91 through 2000. So nearly a decade of growth without any economic downturn. That's quite unusual. And so he was applauded, kind of regarded as a very successful chairman of the Fed. His last name contains the color of the slide until about 2008. And in 2008, we had the Great Recession. Part of the reason of the Great Recession, not the only reason, but part of it, people look at the deregulation of banks over the period of time from 91 through 2000 and beyond, because banks were giving out loans in record numbers to people who were underqualified for those loans. Eventually, what happened in the housing market is that it crashed. People were defaulting on loans in such large numbers that it almost single-handedly toppled our financial system. If you ever want to catch an interesting movie on that, The Big Short came out, I would say 7 or 8 years ago, but a good watch. So that chairman of the Fed is named Alan Greenspan. So we had the Great Recession in 2008 then. So who is this guy? It's Ben Bernanke. Whoops, I flipped through it too fast. That's no fun. He's the former chairman of the Fed from 2008 to 2014. I also put the qualifications on there just so you get a sense of what kind of background the people of the Board of Governors have. So he's a Harvard grad with an econ degree, then later pursued a doctorate in economics from MIT, was a professor at Princeton in economics for almost 2 decades. That's Ben Bernanke, helped kind of guide the Fed through the Great Recession. And if you're not sure who this is, maybe you've seen him recently. He's the newest chairman of the Fed. He was appointed in 2018. He has a bachelor's in politics from Princeton, a doctorate in law from Georgetown. He was served as the undersecretary of the Treasury for domestic finance in '92. He was a board of governors appointee from 2012 through 2018, and he's the first chair of the Fed not to hold a doctorate in economics since the Reagan era. So it doesn't mean that you have to, just in general, some sort of economic background is typical of a governor from the Board of Governors, but not required. Anyway, this individual's name is Jerome Powell. Early returns is that he seems to be doing a good job. We'll see how he and the Fed handles things moving forward as we are entering into a period of speculative inflation, and we'll see how that affects our economy. So thank you for tuning into this presentation. Hopefully you know a little bit more about the Federal Reserve banking system as a result of watching this.